Good morning. How you doing today? Welcome to Stock Markets with Bruce here. It's your buddy Uncle Bruce coming to you live from Creston, British Columbia, Canada. Welcome one, welcome all to the show today. This is September the 2nd, 2021, and we're gearing up here for another fun day of exciting trading, merriment, and hopefully some profit taking. Hopefully, you folks going to make some money today. Let's see what happens. You never know with these markets. Every day brings more developments. And what I try and do, if you're new to this channel, is I try to explain it to you in plain English. That's really all there is to it. I just try to help you figure out what the heck is going on out there. We like to follow a number of stocks that I've got an eye on and see if we can make some money. I did use margin to sell Gamestop puts. There's nothing wrong with having a margin account to sell puts and other things like that. Yes, but to buy stock on margin like GameStop, no, I wouldn't recommend it. The only time I recommend you buy stock on margin with, say, for GameStop, is say you have 180 shares or you have 80 shares. You buy 20 shares on margin to get you to 100, allowing you now to write a contract against the stock, like a call contract. Yes, then I say absolutely. Borrow the broker's money, buy your 20 shares, top up to 100 shares, write a contract, say for 3 weeks from now, $15 a share. You'll bring in $1,500 in cash. And that pays for 7 of those shares right there. Just 7.5 of them are right there covered now, and the other 13 you bought, you still owe. The option expires worthless, or you buy it back for $5 or $3. You write another $15 contract. After 3 or 4 option rollover rights, you have no debit balance anymore in your account. You own all 100 shares. They're all bought and paid for. Going forward, you keep writing an option, and eventually you'll have enough money to buy another 30, 40 shares. You'll get to 130, 140 shares. You may at that point in time borrow money from your broker to buy 60 shares more to get to 200. And now you're going to write 2 contracts at a time. So sure, you're borrowing at 60 shares at $214 a share. You're paying $13,000 to buy the stock on margin, but you're now writing 2 contracts at a time with $15 premiums. That's $3,000 per write coming against that $12,000 debit. So if 2 of the 3,000 is net profit, every 2-3 weeks you bring in the $2,000. It won't take long to pay off the $12,000 debit balance, and now you own 200 shares outright. A couple more weeks go by, and you'll have another $3-4 towards stock. You might be at 225 shares. You borrow enough money to buy 75 more, 300 shares. 3 contracts at a time, and away we go. Here we go. This is how you manage it without being over leveraged and being overexposed to too much margin. This is smart, steady, practical, conservative investing strategies where you can build up a portfolio, build it, and enhance your revenue. Yeah, that's what it's all about. You betcha. Since someone mentioned swaps earlier, a month ago, can you explain what those are and what they can be? Even watching The Big Short, I don't quite understand the credit or other swap concept. Swaps are just a way to bet on something off a market. So you're going to a ball game with a friend of yours, and you're watching the ball game, and it's the bottom of the 7th inning, and the hitter gets up, and if he gets one more hit, it'll be his 1,000th of his career. And your buddy looks to you and says, I'll bet you $50 that guy will not get a hit at this at bat. And you take that bet. Well, that's a swap. That's an off the record, off the market bet. That's a swap. Another guy listens in from behind you and says, I'll give you 10-1 odds that he won't hit a home run. He'll do everything but hit a home run at this at bat. But if he does, I'll give you $500. But if he doesn't, you owe me 50. That's another form of a swap. And now we've got this action going. And then we have people betting on the home run guy. They're betting between each other about whether that guy's to pay out or not. And on go it just goes on and on and on. credit swaps and all kinds of stuff. Anyway, David says, I wrote a covered call on GameStop last week. September the 3rd expiry tomorrow, 195 for 550. I don't want to get exercise, so I bought it back for 2250, lost 17 bucks on it, but I rewrote a new one. September 10 next week, 215 for about 2250. And I got all my money out of there. Now you've raised your exercise price by $20. You have 1 week for the expiry. And don't forget, Monday is Labor Day. We're closed. So in reality, you've written a contract that only has 4 days of life next week, not 5. So it's going to depreciate faster because Labor Day is untradeable. So good move. Now we'll have to see how it works out for you. We'll keep an eye on that. If the shares want to go higher between now and next week, don't worry about it. You'll buy back your call. Let's say the shares are 220 next week. You'll buy the calls back for $10, $12, less than you paid for them, and roll over into 220s for the week after. And that'll get you 12, 15 bucks, and just keep lifting the price of the stock. The contract, as soon as the shares back off, if they back off $10, $15, and you know they can, they were yesterday as high as 231. They were as low as 208. They closed at 212. So, $18, $19 drop from the high of the day. You get an $18 drop on your stock. These right here, these 215s, if the shares here go from where they are now, 215 to 205 or 198, these 215s will drop from 2250 to like 8 or 10 bucks. You could buy them back, wait, cross your hands, cross your arms. Stock comes back up to 205, 210, write them again. Stock backs off $10, $15, buy them back. Stock goes up, write them again. I mean, you're in control here. You're in charge. Nice job. I like it. I'm short a deep in the money put on SoFi. 1750. October 15. Now, I want to bleed more theta out of it. How close to expiration would you let it get before rolling it? Okay, well, excuse me. SoFi now is at 1443, so you're about $3, out of the money. The put's in the money, obviously in your case, but I would wait. I'd wait a couple of days before. I mean, if there's no premium now, if the contract is trading at book value, like truly at about 3 right now, then waiting makes no difference. But if there's still a premium, like 50 cents, 80 cents, $1 premium, you might as well wait. On the other hand, having said all that, you might want to turn around and say, you know what, Bruce, I'm going to buy this contract back now, because if I write a new contract, let's say I write a December or a January or something, I can write a 1750 out there for a much higher premium than what this one's trading for. I can buy this one back for 325, 350, 375, whatever the price is. But I can write a new one for 3 months further out for like $2 more, all added premium. You might consider that strategy, because if the shares in the next month or two go to 1650, 1750, where they were only a few weeks ago, this contract will be at no book value, only premium value, and it might give up $2 right away. $2.50. That might be enough of an incentive for you to buy back the put on a nice little pop. On the other hand, if it goes to 18, 19, and 20 by October, November, you're into January, 1750s, you might be down to 40% of what you got for it, or a third, and you could really score a nice deal. Figure it out. It's all good. What IBM calls to buy would you recommend? Well, I have been indicating to people that you should really consider next year contracts, so at least January, but probably April or May or June. I'd go way out. Even if you're buying out of the money IBMs, go way out. Perhaps look at 150s, 55s, even 160s. The reason I say that is because if the share splits 2-for-1, and you get one of the Kyndryl shares and one IBM share, I have a feeling there'll be options on Kyndryl and IBM, and so you'll have one option for each, I'm guessing. So you'll have two options instead of one. Now, if the split is like, before the split, you have one IBM share. After the split, you have two IBM and one Kyndryl. Or you have three IBM and two Kyndryl. You do that, they have that kind of a deal. Well, then you're going to have 5 contracts, I think. That could be interesting, really interesting. And I'm kind of wondering that once the split is done and is absorbed and digested and understood and analyzed, what if the shares are trading at 175? The parts, you put the parts back together and go, oh wow, it's $175 for the old stock. If you're long a contract with a 150 exercise or a 160 exercise, stock's at 175 plus time value, you could do really well by this. And if you end up with multiple contracts, you end up with, say, 2 or 3 or 4 or 5 contracts from one. Every time these shares go up $1, you've got leverage now, 5-to-1 leverage instead of 1-to-1. That's why I'd be looking, out there. I can't tell you this is going to happen, though. Like, I can't tell you that for sure you're going to get 4 or 5 or 6 contracts. You might end up with just the one or one of each. That's the gamble. That is the gamble. But the downside, I think, is non-existent. I don't think it goes down in value when it's all said and done. I think it holds or goes higher. That's why the split is being proposed and being voted on and being done. So I like the deal. Thank you, everybody, for that. If you'd like to talk to me about a 1-hour session, you want to get together with me, send me an email through my email address, which is right here. It's the old school hotmail.com email address. Send me an email. Say, Bruce, I'd like to talk to you on a one-on-one session. When can you book me in? I'd like to make a reservation and lock it in right away.